Hello and welcome to Hot Money on Bloomberg Quint Live, India's first digital live streaming business news service. This is a show which gets you a complete wrap of all the stocks that are buzzing in trade. I'm Darshan Mehta. Let's welcome our experts on the show. Joining us today are independent market expert Shaina Mukaddam, Vinita Sharma of Narnolia Financial Advisors, and Dharmesh Kant of IndiaNivesh Securities. Many thanks to all of my guests for joining me. On the show today, we discuss the auto stocks and whether the rebound is here to stay. We ask our analysts about their pecking order in this sector. We also discuss the metal space and the hopes of a US-China trade resolution rising. Will they see respite after the battering that they have taken? PSU banks have been in focus post the recent recapitalization and the consolidation announcement. We discuss any stock is worth buying in this sector. And lastly, we ask our analysts about one stock that they are recommending their clients to pick in this at these current levels. So those are the stocks that we will be discussing in today's edition of Hot Money. Let's start with the first one, and that's the auto space in such. The numbers have been disappointing. The August data that came out was disappointing, but yesterday, surprisingly, all the auto stocks managed to rebound. Today, they've given back most of the gains, but what's the view on the auto index? Are there any stocks in this space which are guest-like and are recommending to their clients? That's something that we'll talk about. So, Vinita, I'll start with you. Overall, things are pretty bad in the auto space. You believe we are coming close to the worst? Is the worst over? And are you recommending any stocks in this space to your clients?
So see, Darshan, definitely this is a pain period for most of the, in fact, all the auto stocks or auto components, etc. And at this point of time, most of the shares are at their cyclical low valuation. And if we compare the FADA and SIAM's data, we understand that more pain is because of the dealer inventory that was stuck up. And already, once the volumes came up and we saw the SIAM data going high, all these auto companies, they pushed in then volumes to the dealer level, and that's a pain. And obviously, along with it came the consumption slowdown, etc. As of now, I think there are two stocks that I would recommend going forward. One is Maruti and the other is Bajaj Auto. Because Maruti, it has 50% plus market share. Also, the kind of changes Maruti has brought to Indian passenger vehicle sector. I think that brand franchise, the kind of dealer network it has, the service centers, these are things which are important for an Indian consumer. So I think Maruti, the valuations are also pretty comfortable right now. So somebody going for a 2-year, 3-year kind of a story, they can have Maruti. Second is Bajaj Auto, given the kind of market share that it has been gaining in the past 1 year because of the strategy change that they undertook. I think these are the two stocks we are liking. For all these commercial vehicle segments or the tractors, we are still wait and watch mode, because infra has to, that push should be seen clearly, and right now we are not witnessing that kind of a capex right now.
Just one question. Maruti, obviously you explained it. Bajaj Auto, what is Bajaj done right that Hero isn't doing right?
So what? See, right now what I expect is, the Bajaj Auto initially, they because of the they have given price cuts on their thing, and they want to have a better market share. Because in Hero Motor we are seeing more of a rural crowd coming, but Bajaj has a Pulsar also, it has upper variants also. So I think with the kind of price cut it took earlier to gain more volumes, also the export market is better for Bajaj, so it is kind of hedged. Even in the, so right now currently we have seen the export volumes still coming better, which has been a volume breather for Bajaj. So I think that ways we are liking. Bajaj is a good cash flow business, in fact all of them, and the dividend yield is also pretty good. So I think Bajaj Auto will be, because now they have a strategy in mind and they have taken that forward.
Okay, Dharmesh, your sense, should one start now accumulating auto stocks, or you believe that it's still time for more consolidation?
And there is still time for more consolidation, because this is actually a downtrend. Okay. So what happens is, first it's a slowdown, then it's a recession. So it's nothing, a recession directly doesn't jump into the ground. So my own sense is it will take at least 2 quarters before any base effect will come into play. If you look at the numbers as far as passenger vehicles are concerned, so Maruti started slowing down from FY18 itself, October. So FY18, and now you are having the real degrowth happening for last 4 months. So April this year onwards, you are seeing a clear marked degrowth in passenger vehicles, commercial vehicles, and two-wheelers. So still 2 quarters to go before this, the base effect will come into play.
But stocks have already corrected 50-60%. You don't think it's priced in?
No. Yaar, see, what is valuation? Or what is a PE multiple? It's a multiple, it's a ratio of earnings, right? If earnings is to go down further from here, so how can we say that this is the limit? So that's the question which we are trying to address as of now.
Okay.
Whether this valuation is
okay.
the right
So your view is there could be more downside. Among the many, there's two-wheelers, there's commercial vehicles, there is passenger vehicles. Any of these stocks, are you telling your clients it's a decent valuation, it's time to start accumulating?
Just start trading back. Nothing to do with fundamental valuation or long-term holding. We think Hero MotoCorp can do well in this festive season when compared to others. So because there's a clear, if you look at Eicher Motors numbers, the numbers are far pathetic. It just started. So high segment, mid segment won't sell. Entry level segment will still have attraction going forward. And Hero fits the bill very fast with his rural India presence, pan India presence. So we think just you can have a 10% or 15% kind of a trading outplay. Some has 5-7% has already been played out in this recent pullback. Some more to go.
Which is the worst placed in the auto space?
Eicher Motors.
Eicher Motors. And you believe that there could be?
It can even half from here.
Okay. China, what's your sense on the auto space? First, if you can also, do you also believe that Eicher probably could be the worst among the two-wheelers, and then your view on the auto space?
I used to have a very overvalued cell called an Eicher earlier, but seeing the way the government is actually pushing electric EV vehicles, I think Eicher's engine, the advance that they have done and the engines that they have got in EV, I think that is going to hold them in very good stead going forward.
Okay.
So as of now, I wouldn't be a seller in Eicher.
Okay.
I think after the nice correction that we've got, if I'm an investor, I will continue holding it just for the EV engines. Okay. In terms of the overall auto sector, I agree with both. I think there is going to be another 1-2 years of consolidation, disappointment in numbers. I think there has been a structural change in terms of the overall auto sector. So while the July and August numbers, July was down by 25%, August was even worse. So while these numbers are a reflection of what Vinita was touching on, which is the dealers were overstocked at one point in time. So that to some extent there is some correction out there. But I think more than that, why I am seeing a little longer term pain is because of the structural change. The government is pushing EV. There is no chance. I think they've made it very clear that they will cut the GST rate. Okay. So to that extent, I think there is a wait and watch. Nobody really wants to go out and buy any vehicle as of now. So the reason why I would give a buy on Maruti despite all this at current levels is, one is that the valuations have really corrected to decent levels. I won't say that any investor is going to make money in the next 6 months. Okay, but if I was to look at the segment and look at a stock which I think is in a position to take corrective course and then come out on the tops, okay, in the four-wheeler segment, it would be Maruti in two ways. One is that they are pretty advanced in terms of EV. I think they have got the strength and the capability of coming and matching with good products which will be acceptable. Two is, even if you see that the problems that they were having currently, they are taking measures to cut costs by cutting production at the Gujarat plant. So they are taking measures to mitigate the shorter term pain. So I think valuation also at about 24 times, 23, 24 times is not too expensive compared to what we've seen.
Okay.
So I would.
So Maruti is your top pick in this thing. Anything in the two-wheelers that you like, or would you just stick to Maruti being the top pick?
Well, I think I will go with Bajaj Auto in the two-wheeler. While they are having pains in some of the upper end, two-wheelers, but they have got their their steady, like Pulsar. They have got some of their good products which are doing well. Exports, I think if they are able to increase their exports, they should do reasonably well. And also in the EV, they are there. But I think EV will be less impact on two-wheelers than four-wheelers. So to that extent, I would go with these two.
Okay, so those are the stocks that we've spoken about. I think the consensus view is there could be more few quarters of pain coming in. The stocks could even see more further downside. But what our experts say, you should start nibbling into counters like a Maruti, Bajaj Auto, or a Hero Motor. Eicher probably still remains. As per Dharmesh, there could be more pain, but China is quite optimistic on Eicher because of the EV play. So that's the broad theme that we spoke about on the auto space. The other theme that we want to speak about, and that's also the metal space. Now, yesterday the metal stocks did manage to rally in trade. Today morning also they rallied, but they've come off the day's high. Basically, in terms of what's and the stock and the sector is basically reflecting what's happening on the global trade arena between US and China. While most of the stocks have cooled off, I think two stocks which on the metal side, pseudo metal stocks are HEG and graphite, which have actually managed to surge today. But apart from it, most of the other metal stocks have managed to come off significantly. Dharmesh, makes sense for anyone to start getting into metals, or you think that just avoid given what's happening on the global scene?
So I will still go with just avoid given what's happening on the global scene. See, rhetorics can be there, talks are there, but the ground reality is Eurozone is growing at 0.2% GDP growth rate is there, which is almost 30% of the world GDP. US, which is 20% of the world GDP, is not having a traction of even 2%. So there's a clear slowdown, and in this slowdown, with excess plant facility and supply being there in China, they are not getting a market. So taxation and all is fine. Anyways, if you want a production, whether US produces metal or China produces metal, metal has to be produced for the production. That demand is not there. And last month data of China came, producer price index fell by 0.8%, where CPI went up to 2.7, 2.8%. So this is again a very difficult scenario, where consumer price inflation is there, producer price inflation is not there. So how the wages and salaries will go up? So this shows the economic downturn is already there in place. So you on this news flows you may have a bounce back, as you said rightly. Yesterday metals were up, today it is down in spite of opening up. So this is the nature of the trade which will be there. I think it would be technically speaking, it will be a lower tops and lower bottoms.
Okay, so you think there could be more pain coming in? Not take any bets in the metal space at this point of time. Would that be your strategy, or China, or do you like anything in this space?
See, I agree that there is, the global war between US and China is a level of concern for all of us, and there is a slowdown in the overall economy, and it's going to get worse if this war, if this trade war aggravates further. But I will go with the positive part, thinking that there could be some settlement between these two, and if that happens and there is a stabilization in the overall world global economy, I think it is possible that local steel prices will stabilize. Another thing is there is a depreciation of the rupee, and the government has put certain restrictions on imports of steel and metals. So to that extent, there is a protection for the domestic industry in terms of further correction in prices. Prices are stabilized. So I would be selective buyer. I'm not saying put a large part of the portfolio into metals, because over a long-term period they have not been such a good performer in terms of overall sector. There are other sectors that have given you better performance. But if one was to pick in, one can pick in one or two steel companies. JSPL hai. My pick for today is JSW Steel. JSW Steel largely I'm picking over the rest as of now is because they are expanding the capacity from 18 million tons to 24 million tons. They are putting in place certain operating efficiencies which is likely to improve the EBITDA margin along with increase in capacity. And valuations are also attractive at about 6 times EV by EBITDA. So these are the reasons why I'm picking JSW Steel as of now. I think it should be a small part of your portfolio, metals.
I think metals usually are very cyclical, so it's always hard to catch the bottom. So I think that would be a good strategy, being selective and taking some bit of metal stocks. Vinta, anything that you all as a house have told your clients now, is it the right time to start accumulating, or would you be as negative as Dharmesh?
So, like metal space, we have not been very bullish in the space, and mostly we recommend it from trading point of view. So as and when the metal prices, because most if we look at it, most of the metal stocks, they make 52-week high and 52-week low in one particular year itself. And that is more based on how the prices move. And given the current scenario, still the volatility persists in. So we cannot say we are out of the volatility in what the US, China, etc. will go off. So there are two stocks which are good in particularly metal space. Is what we like is Hindalco and JSW. But I would ask investors, to play more of metal proxies. Like we like Ratnamani Metal. So it's a pipe company. which produces CS carbon steel pipe as well as stainless steel pipe. The balance sheet is very clean. The balance sheet is light. They have gone for capacity expansion. The order book is around 2,000 crore, which gives you sufficient, top line growth visibility. Also, this time, after a long time, they have touched the 2,000 crore order book at one particular time. Last time when they did it, it was more of, CS pipe, which has a little lesser margin. So this time the contribution for SS pipe is little more, which will give not only the top line growth, also the EBITDA margin will remain around 17%. So I think it's a good play given all the vagaries of metal space. I think Ratnamani is a good play given the balance sheet positioning, the top line PL positioning, as well as the valuation side.
Okay, so that's the view that's coming in on metal space. Obviously, you need to be extremely selective. The consensus view is that there could be more pain coming in for the metal sector, but a few stocks that were discussed on the positive side and should be taken on a long-term basis with a little bit of allocating part of your portfolio to the metal space. Ratnamani Metals, a pseudo metal story that is there, and JSW Steel is the second one that's been spoken about. The next discussion that we want to do is the PSU banking. We've seen that most of the PSU banks stocks have actually corrected significantly, and we ask our guest whether the recapitalization that is there helped the PSU bank move up in trade. Dharmesh, your view on the PSU banking space?
I think cherry picking can be done in the PSU banking space. This is the right time where you can go on averaging. And this is an investment call. It's not a 2 month, 3 month or 6 month kind of a call which you are taking, because after the announcement of mergers, the ratios has still not been announced. That they have not been finalized. So out of the entire basket, I find Canara Bank a very attractive bet. Post its merger with Syndicate Bank, if you work out the ratios, the price to book as of current market cap would be 0.42. But they have a lineup. 6,500 crores of equity infusion would be there in Canara Bank, and 6,000 odd crores of QIP they have lined up post Canfin Homes stake sale happens. So all put together, it will be 0.34 times price to book. So which is quite reasonable. You have nothing to lose from here. Even if you don't get, your capital gets protected. At the same time, the tier 1 capital and CET1 ratio, capital adequacy ratio will increase very significantly. Capital adequacy will go to 15% after all this equity infusion takes place. So this gives them a bandwidth to play. And the catch point here is this additional equity, the deposits which they are lying, which they can use for lending, can be used at the cost of NBFCs which they are losing business. So now private sector banks are catching that space. So now public sector banks with the renewed vigor, they can use that. So I find that attractive. SBI always has been a top pick from the basket, but the valuations are far higher than SPR. So one can look at that.
Okay, Canara Bank, and would you still prefer private sector banks for Canara Bank, or are you sensing that there could be trouble there also?
No, there would be a trouble in private sector banking space because they have not been so aggressive. Initially, what was happened, this is my view, that RBI was more lenient on private sector banking space. They thought that they have already been provided for. And they had a very much larger exposure to NBFCs than PSU banking space. So PSU banking space exposure was more to infra, power and metals, which has already been accounted for. NBFC trouble was not there in PSU banking space to a larger degree, which is there in private sector space. So this has to be addressed by them. So it would be a reverse play for 6 to 9 months. I mean, 2 to 3 quarters you will see PSUs doing well on the NPA account and fresh slippages account, whereas private sector coming out with disappointments there.
Okay, Shaina, do you like the PSU banking space, or would you stick to the private sector banks?
I'll stick to the private sector banks. While the merger of PSU banks was a big story and has seen I would say, relatively stabilization of PSU bank stocks, and maybe technically it could be a bounce, I would avoid it. See, what I feel, the merger has taken place because the government had no choice. Each of them individually, small ones, the government cannot go and recapitalize each of them, and it was just like putting money down the well, right? So they had to merge. They have no choice. But that is not, in my view, going to give any from a shareholder point of view, going to give us any economic benefit. There, it is going the merger to result in cost efficiencies, to result in this PSU banks merging together culturally is going to take a lot of time. So I think the savings are not going to justify an investor going in and putting money at this point in time. I don't see their lending, which has come down to very decimal low levels, move up substantially now. I see them continue to lose market share to private sector banks. It is only that private sector banks in the last couple of months, I would say 2 years, 3 years, had their own problems, which is what we are seeing in terms of the stocks. But I think they are better positioned to take corrective measures. Even something like a Yes Bank, you know, with such a bad situation, I think a PSU would have wound up by now. I mean, it's such a bad situation, but they are able to manage to come and get out of it, right? I don't see that happening with PSU banks. So for a long-term investor, I rather take opportunities where I'm getting in private sector banks where the valuations have come down for whatever negative reasons, and remaining invested for a longer term.
Okay, avoid PSU banks.
Avoid PSU, but if one has to invest, and I personally also recommend SBI is one where you can invest, because SBI is like a quasi private sector bank. It has its own problems that we saw in the last quarter. There was a substantial deterioration in numbers in terms of stressed assets going up, but I think they are well positioned to take corrective action. In fact, they've just announced sale of SBI Life, almost 4.5% of the equity, which can get them, I think, about 3,500 crores. They hold, I think, more than around 70%. I'm not. So they hold a huge chunk of that equity. So there is such, measures which they can take to increase the liquidity in the bank and to improve their loan growth, which was low in the last quarter that we saw. So I think if one has to be invested, valuations also are attractive in my view. So one can invest in SBI.
Okay, Vinita, anything from your house views that you have any positive view on any of the PSU banks? Are you pushing any one of them?
So we're liking two PSU banks. One is SBI, which is most talk about. The second one is Bank of Baroda. Like what Shaina was mentioning, that the consolidation of the banks will take a good amount of time, because it's not two banks consolidating on a balance sheet point of view, but also the people merge, and the technology and everything changes. The product, processes, a lot of changes are there. And I think because Bank of Baroda was the first one where the merger happened, and some good amount of time has passed on, and now I think things are product, processes, services are more settled. Secondly, if we look at initially also before this merger of Bank of Baroda, the technology front for Bank of Baroda was improving. So and also they were taking more of they had exposure towards the retail assets more. Because we saw currently also, if the overall growth is around 10% for the advances, the retail part is growing by 20%. So that way the books are in a better shape for Bank of Baroda. Currently we have seen high slippages in the company, and that will continue for 1 or 2 more quarters because of mergers. But then going forward, we see that the PCR is already 70%. In the NCLT accounts, there is 89% provisioning, and there is good amount of chance that a write-off will come back, which will boost the profitability of Bank of Baroda. So in the PSU segment, one can stick on with Bank of Baroda.
Okay, BOB and SBI are being spoken about. And finally, in the market, which is extremely, at least in this month, it's been rather sideways, we ask our guest whether there is any stock that they have told their clients to start accumulating. Shaina, have you told your clients to start accumulating any particular stock?
Yeah, I'm very positive on cement. I personally have taken some exposure in ACC some months back. Okay. And I think cement has two positives. One is actually you have sentiment positive, in my view, is likely to happen where the GST is likely to be cut from 28% to 18%. That would give a positive boost. And I see, if you see in the last couple of months, the last quarter, cement has been one sector which some companies have given nice numbers, both in terms of volume as well as in terms of profit growth. And my pick over here would be ACC, which I personally also hold. There I think valuations are attractive, as well as they have shown very good growth in the last quarter with the government's push on low-cost housing. I think they would benefit. They've got a presence across India.
Okay, so ACC is your top pick. Is anything that you have told your clients as your top pick right now?
So right now we are pushing credit as well as consumption. So since we've talked about credit a lot, so on the consumption side, we are pushing DMart.
Okay.
Considering the under penetration of the retail market, and the way DMart is strategizing, it's not going in for aggressive growth. In fact, they are taking very prudent growth going forward. Stores are being opened only where good sourcing is available. So that way, I think even if they are working on a thin margin, they will be able to protect the margin, and which normally becomes a very big problem for any kind of a retail industry. And also the inventory turnover is only 3 days, which gives the balance sheet positioning, everything. And with the recent consolidation of the DMart prices over the last 1 year, I think the price to sales has also come off a bit. So that way, looking at the valuation side, also a safer bet where the balance sheet problem is not there, everything is clean. I think one can go for DMart.
Okay, ACC, DMart, and Dharmesh, anything that you all have been telling your clients right now to start accumulating?
Yeah, just from trading perspective and sensing the fact that government has done the fiscal maths well by RBI dividend into the kitty, so some influence spending will be there. So L&T remains the top pick out there because they have been already the leaders as far as order books are concerned. And apart from that, Hero MotoCorp we have spoken about, and Canara Bank. So these three stocks, I think, as a basket can be played as a trading bet for a few months.
Okay, so that's the view that's coming in. If you want to take some positional bets in the market, counters like in ACC, DMart, there is Canara Bank, Hero MotoCorp, as well as L&T that we discussed in this segment. But with that, we're completely timed out on this edition of Hot Money. Let me take a moment to thank all my guests who have come in. Shaina, Dharmesh, thank you for coming in. Vinita, thank you so much for coming in. Ask BQ comes up next. Stay tuned to Bloomberg Quint.